If you are currently receiving Canada Pension Plan or Old Age Security benefits, or if you are preparing to submit your application in the coming months, February 2026 deserves your close attention. Canada's retirement income system contains several interconnected components, and while not every adjustment translates into a reduction, certain changes throughout the year can directly influence how much money actually arrives in your bank account each month. The critical question facing Canadian retirees is not whether the entire pension system is facing collapse or whether benefits are vanishing without warning. The real concern that demands examination is far more personal. Could your individual payment experience a decline? And if that happens, what specific factors would be responsible? This examination takes a measured, evidence-based approach to understanding what occurs during the February payment period, how Canada Pension Plan and old age security payments are determined through official calculations, and the precise circumstances that could trigger a reduction in your monthly deposit. Canadian retirees must first recognize that both the Canada Pension Plan and old age security programs function according to structured mathematical formulas established through federal legislation. These payments do not experience random fluctuations based on arbitrary government decisions. However, they remain sensitive to several variables, including income levels, contribution histories accumulated throughout working years, decisions about the age at which benefits commence, taxation factors, and interactions with supplementary benefits such as the Guaranteed Income Supplement. When a payment decrease occurs, it typically results from one of these specific variables experiencing a change, rather than from any sudden policy decision to reduce pension amounts across the board. February holds particular significance within the Canadian pension calendar because it immediately follows the January indexation period when annual adjustments take effect. Canada Pension Plan benefits undergo adjustment once annually during January, with the increase calculated based on movements in the Consumer Price Index over the preceding 12 months. Old age security follows a different schedule, with payments reviewed on a quarterly basis during January, April, July, and October of each year. When inflation demonstrates a significant slowdown or remains relatively flat compared to previous periods, benefit amounts may not increase during a new quarter. While this technically does not constitute a reduction in the formal sense, many Canadian seniors interpret the absence of an expected increase as effectively falling behind their actual cost of living. However, an actual decrease in payment amount requires something more specific occurring within an individual's financial circumstances. One scenario that frequently reduces old age security payments involves the OAS recovery tax, which Canadians commonly refer to as the clawback. If your net income during 2025 exceeded the annual old age security threshold established by the federal government, a portion of your OAS benefit will be recovered beginning in July 2026 and continuing through June 2027. However, adjustments to withholding amounts or tax projections can begin appearing earlier in the calendar year if you have updated income information recorded in your Service Canada file. If you experienced a higher income year due to registered retirement savings plan withdrawals, capital gains realized from investment sales, rental property income, or earnings from part-time employment, your February payment may already reflect adjusted withholding amounts designed to address anticipated recovery tax obligations. Canada Pension Plan deposits can also appear lower during February if tax withholdings undergo modification. Many retirees overlook the fundamental reality that both CPP and OAS constitute taxable income under Canadian tax law. If you previously requested voluntary tax deductions from your pension payments, or if Service Canada adjusted your withholding percentage based on information from prior tax filings, your net deposit amount can decrease even though your gross entitlement has not changed whatsoever. Another critical factor affecting retirement income involves the Guaranteed Income Supplement. This benefit undergoes income testing and recalculation every July based on information reported in your prior year's tax return. If your 2024 income exceeded what officials expected, your GIS amount beginning July 2025 may have experienced a decrease. That reduced payment rate would remain in effect through February 2026 and beyond until the next annual recalculation occurs. Many Canadian seniors express surprise months after the fact when they discover that their lower payment traces directly back to income changes reported in tax returns filed long before. Understanding this delay between income events and benefit adjustments proves essential for retirement planning. Income for these calculations encompasses far more than employment earnings alone. Withdrawals from registered retirement savings plans or registered retirement income funds count as income. Pension payments from employer plans, interest earned on savings, dividends received from investments, and certain foreign income sources all enter into the calculation. If you withdrew a larger amount from your RRIF during 2024, even for a one-time expense such as home repairs or medical costs, that withdrawal could reduce your guaranteed income supplement entitlement for an entire benefit year spanning 12 months. The matter of Canada Pension Plan post-retirement benefits also warrants examination. If you are under 70 years of age and continue working while simultaneously receiving CPP payments, you continue making contributions to the plan and earn a post-retirement benefit that gets added to your payment the following January. In most circumstances, this addition increases your monthly amount by a modest percentage. However, if you ceased working during 2025, your new post-retirement benefit calculated for January 2026 may be smaller than additions received in previous years. This does not reduce your existing base pension amount, but it may create the perception that your benefit growth has slowed compared to expectations. Contribution enhancements implemented under the CPP expansion that commenced in 2019 continue their phased introduction. For working Canadians still in the labor force, contribution rates have gradually increased over several years to fund higher future benefits for upcoming generations of retirees. However, Canadians already receiving CPP payments will not experience sudden cuts because of this enhancement program. The expansion applies prospectively only to contributions made during working years going forward. It does not reduce base entitlements already calculated and in payment. Turning attention to old age security specifically, another issue that frequently creates confusion among recipients involves residency verification procedures. OAS eligibility depends fundamentally on the number of years an individual lived in Canada after reaching 18 years of age. If Service Canada conducts a periodic review and requests documentation to verify your residency history, and that documentation experiences delays in submission or processing, payments can be temporarily paused until verification completes. This circumstance remains relatively rare, but certainly possible. A temporary suspension resulting from missing or delayed paperwork can feel identical to a payment reduction when checking your bank account balance. Banking information changes also matter significantly for payment delivery. If your direct deposit information has become outdated, or if a payment was returned by your financial institution due to a closed account or incorrect account number, your February deposit could experience delays. While this situation does not represent a policy reduction in benefits, it affects your cash flow in a very tangible and immediate way. Economic conditions around inflation deserve discussion as well. If inflation slows significantly during the measurement period, the January Canada Pension Plan indexation may prove modest compared to previous years. Seniors who anticipated a large upward adjustment based on recent experience could face disappointment when reviewing their January and February statements. If your personal expenses continue rising while your pension increases only slightly, the situation can feel equivalent to a reduction in practical purchasing power terms. But this phenomenon ties directly to broader economic conditions affecting all Canadians rather than representing any targeted policy decision to reduce pension benefits. Taxation at the provincial level introduces additional complexity for Canadian retirees. Changes to provincial tax credits, age-related credits, or benefit offset programs can affect your overall net income position. While Canada Pension Plan and Old Age Security remain federal programs administered through Service Canada, your after-tax reality depends substantially on your province of residence and any changes that provincial government implements. Another frequently overlooked issue involves marital status changes and their ripple effects through the benefit system. If you were receiving the guaranteed income supplement calculated based on couple status and your spouse's income subsequently increased, Your combined household income may reduce your personal GIS entitlement. Conversely, if you became widowed during the benefit year, your entitlement could actually increase to reflect single status and different income thresholds. February payments reflect whatever marital status currently appears on file with Service Canada. For Canadians turning 65 or 70 years of age around this period, timing decisions made regarding benefit commencement carry lasting consequences. Initiating Canada Pension Plan benefits at 60 years of age permanently reduces your monthly amount by a significant percentage compared to waiting until 65. Conversely, delaying benefits past 65 increases the monthly amount received. Old age security increases by 0.6% for each month of deferral past 65 up to age 70, allowing for a maximum increase of 36%. If someone begins receiving benefits earlier than optimal for their particular financial situation, their payment may be lower than expected, but that difference reflects their personal election choice rather than any policy decision affecting them. Clarification about what does not occur during February proves equally important for understanding the Canadian pension landscape. There exists no automatic February reduction applied universally across all Canadian seniors. Canada's pension system does not incorporate surprise across-the-board cuts announced mid-cycle without warning or legislative process. Structural changes to benefit formulas require parliamentary legislation and undergo public documentation and debate before implementation. However, individual circumstances absolutely can cause payment fluctuations at any point during the year. The most common reasons for a payment drop include higher taxable income affecting guaranteed income supplement calculations, exposure to old age security clawback provisions, updated tax withholding percentages applied to payments, marital status changes reported to Service Canada, and corrections to previously reported income information. If you harbor concerns about a potential payment drop during February 2026, the most productive immediate step involves reviewing your 2024 and 2025 tax returns with careful attention. Examine your net income figures closely. Compare those amounts against published GIS income thresholds and OAS clawback trigger points. Confirm whether you previously requested voluntary tax deductions from your CPP or OAS payments. Accessing your My Service Canada account online allows you to review detailed benefit statements, showing both gross entitlement and deductions applied. This breakdown clarifies exactly how your net deposit amount was calculated. If your payment changes and you do not understand the reason, contacting Service Canada directly represents your best course of action. Representatives can explain whether the adjustment relates to income testing, taxation changes, benefit recalculation based on new information, or other administrative factors. Planning your registered retirement income fund withdrawals with care also proves wise strategy. Large withdrawals concentrated in a single calendar year can reduce your guaranteed income supplement for the entire following benefit year. Strategic planning that spreads withdrawals across multiple years can smooth your income profile and prevent unintended benefit reductions. For higher income Canadian seniors concerned about old age security clawback exposure, managing taxable income through tax-efficient withdrawal strategies, and understanding exact threshold amounts can meaningfully reduce recovery tax obligations. Financial advisors with specialization in retirement income planning can help structure withdrawal patterns to minimize exposure to the clawback provisions. Working retirees who continue contributing to the Canada Pension Plan should understand that post-retirement benefits accumulate incrementally at modest rates. These additional amounts build value over time, but do not dramatically transform total payment amounts overnight. If inflation remains moderate through the measurement period, CPP indexation calculated for January 2026 may not produce dramatic payment increases. This outcome does not indicate any weakness in the pension system itself. Rather, it accurately reflects underlying economic data about price changes throughout the Canadian economy. One additional issue deserving consideration involves overpayment recovery procedures. If Service Canada determines through review that you received overpayment of GIS or OAS during any prior period, officials may initiate recovery through monthly deductions from your ongoing payments. Such a deduction would reduce your February deposit below what you might otherwise expect. Overpayments can occur when income was initially underestimated on applications or when marital status changes were not reported promptly to the department. The central theme emerging from this examination confirms that payment drops are usually personalized to individual circumstances rather than universal across the retiree population. Canada's retirement income framework rests upon three foundational pillars working in combination. The Canada Pension Plan provides earnings-based benefits reflecting contributions made throughout working years. Old Age Security delivers residency-based benefits tied to years spent living in Canada. The Guaranteed Income Supplement offers income-tested support for lower-income seniors. Understanding which pillar you rely upon most heavily determines your personal exposure to adjustments based on changing circumstances. If your income remains modest and stable from year to year, your payments are unlikely to fluctuate dramatically absent some reporting change or administrative correction. If your income varies substantially due to investment returns or withdrawal patterns, expect possible GIS or clawback adjustments as the system responds to your reported income changes. Remember throughout this analysis that gross entitlement and net deposit represent fundamentally different numbers. Many Canadian seniors focus exclusively on what amount lands in their bank account each month, but reviewing the detailed breakdown between gross benefit amount and tax withheld clarifies whether a true reduction in entitlement occurred or whether you are simply seeing adjusted tax withholding in effect. As February 2026 approaches on the calendar, staying informed while avoiding unnecessary alarm serves Canadian retirees best. Review your tax position carefully. Monitor all correspondence arriving from Service Canada. Keep your personal information updated in official records. And most importantly, develop understanding about how income interacts with benefits across all three pillars of the Canadian retirement system. Payment drops remain possible under specific conditions outlined throughout this examination, but they do not occur automatically, and they are not applied arbitrarily without traceable cause. The more thoroughly you understand how income changes interact with benefit calculations, the more control you maintain over your retirement cash flow. Knowledge gained through research, careful planning implemented consistently, and verification of information through official sources represent your best protection as a Canadian retiree navigating the pension system.